be an interesting conversation. Let's get into some of the market conditions. And, we talked on Wednesday a little bit about CPI.
Right.
Let's get into that again and how that's going to affect rates and, that kind of thing.
Well, I think that, just to give the short version, Larry, since we covered it kind of in detail on the Wednesday program, look, inflation's not going away, right? And the consumer price index and the employment number from earlier this month, in spite of the fact I think the employment number was suspect, puts us in a spot. Those guys are laughing because they're kind of agreeing, right?
Yes.
There weren't. I just find it hard to believe there were 350,000 new jobs created in January, but that's a soapbox conversation we had 2 weeks ago.
Yeah.
I won't rehash it here.
Yeah.
The thing is that with the job growth and with the CPI, which was expected to fall under 3% for the first time and did not, remains at 3.1. That's a big number, right? If you take that 0.02 and you extrapolate it out over 12 months, that's 2.4% additional inflation we weren't expecting, right? So that's the difference between 3% inflation and 5.4 over time. That's a real problem for the economy. It's a real problem for the Fed. Rates dropped from the high of 8% last fall into the 6.5% area early this year on the expectation that the economy is slowing and the Fed would be forced to consider cutting rates as early as March. The numbers of the last week, consumer price index and the jobs report 2 weeks ago, tell us that the Fed will continue to be on hold until at least May, probably June, potentially later.
Yeah.
And the thing about mortgage rates and interest rates in the economy in general is we heard about a year ago the idea that the Fed came out and said, you guys need to get used to the idea that rates are going to be higher for longer than you think. And this is the manifestation of higher for longer. So rates on the mortgage side of things are squarely back at 7% on kind of a base rate basis, right? And all the qualifiers, that's not a quote, talk to your local lender, need credit score, details, 6 points of information in order to get you an actual rate quote, consult a loan estimate before making any final decision and all that stuff. But the fact of the matter is rates in the sixes for now are probably gone. And that's an unfortunate thing for the spring home buying season. But the flip side is, I don't know about you, I had 2 home buyers working last week. Both of them put offers into multiple bid situations and didn't win the property.
Yeah.
And so
there's still action out there.
Yes,
Absolutely.
The shortage of inventory is what's causing this action still.
Yeah. And I think the shortage of inventory, look, there's a couple of things. And what you guys do has a great impact on the ability to improve the inventory situation in the market, right? So, for example, I want to spend a little time. We've got plenty of time on today's show. At some point here, after we get off this topic, I'd like to circle back to the Waukegan property you guys were texting about and talk a little bit about how that's a property that's not in inventory now, right? I've seen the pictures. It's not available for a traditional home buyer. But the thing is that it can be inventory for the right buyer if they have their eyes open. And so, Larry, we spent a lot of time on Wednesday, and we can talk a little bit more today as well about the idea of renovation lending as a tool.
Absolutely.
And what you guys do at Property Pals as a tool to add suitable inventory to the available lot of houses, which right now is way too small.
Yeah. And, if you're going to be an investor in real estate, you have to be a professional distressed home hunter. You need to be able to find those distressed properties,
right?
Because that's your inventory, I think, and that's what's going to be the bulk of your opportunities out there are distressed properties. If you're investing, whether they're 2 flats, 3 flats, single family, whatever.